All right, welcome back, everybody. Let's get started. Couple minutes later, but I want to give a little time for some more people to trickle in. Um, let's go over what we talked about last time. And if you got any questions about what we talked about last time, please feel free to ask them. Don't worry about slowing anything down. So we started diving into the ideas of how we were going to start building portfolios and the ways that you can look at your portfolio and really just be able to designate what assets are for what purpose and be able to give everything a reason. So we kind of talked about how this is just the frame of reference that we have curated based off of all of the industry knowledge and experience over the last good while, working with clients and creating portfolios, what we see works, what we see doesn't work, and what has been understood to work from the industry. So modern portfolio theory is something we'll dive into a little bit deeper later. That's where all the fun, complicated numbers come into play. So that'll be a good time. But really, again, we're just trying to simplify this process and not make it too difficult because it can be pretty simple. It's as easy or difficult as you make it. You can make a really good portfolio with just a handful of funds as long as they serve the purpose as well as they need to. But you can also continually develop and make better your portfolio over time. So the first thing that we start with, of course, is we use our time frame to select our investments. We want to make sure that if we have investments that we need sooner rather than later, that we're not taking on a ridiculous amount of volatility. And if we have a lot of extra time, we can take more volatility because we're allowing those averages to play out over time. And creating a portfolio really just ends up being a balance between these two factors, how much time we've got and how much do we need to have access to these funds at any given moment. So the whole reason for that time frame sort of perspective is because of the law of large numbers. It's because of the more periods you allow yourself to sit within, the ups and the downs, the closer your average annual returns will reflect those that have existed in whatever stock market that you're participating in over the long term. It's a concept that insurance companies use all the time. It's how they make money. When you're insuring maybe $1 million risk for a couple $100 a month, the reason it works is because they can average out that risk and understand how much premium do we need to charge for the level of payouts that we're giving. So how are we using this to our advantage? We spoke about it a lot, but we use riskier assets that we're looking to hold for a longer period of time, and we're using less risky assets for immediate needs. And we make sure that we diversify across asset classes. We diversify across different holdings to make sure that we bring ourselves closer to average values that we hear talked about. Like when you hear somebody say the S&P has averaged 10% a year, that doesn't mean that it's done 10% a year. It means that if you participate in 10 years, 20 years, 30 years, the average of those returns equate to 10% a year. So understanding that difference is really important. We talked a little bit about dollar cost averaging, how it's a really great way to just kind of get into the market. It's what I like to do as we see these downturns. I like to sell out of my more conservative stuff and dollar cost average on the way down. Then I get to hold everything as it crashes and participate on the way up. Just a couple super basic examples. This is kind of the classic way of using short-term, intermediate-term, and long-term assets, using a cash or cash equivalent for money I need to get to right now very quickly, using bonds as a way to have a relatively decent amount of stability while still getting a little bit of return that's not just losing to inflation, and over the long term, participating in the growth of the stock market. So these assets are not necessarily what you will choose for your portfolio because you might have a cash account that you want to layer this way, where you have just straight up cash and money market funds for your short term. You might have a little bit longer short term corporate, different kinds of debt, and then you might have some longer term or higher yield debt, lower credit rating. But overall, it's an incredibly conservative portfolio, because there's no growth in there. There's not a lot of international stocks or individual securities. It's still really conservative, but you're still able to spread it out over time if you want to structure it that way. You could do the same thing with growth. I could say, for example, something that sometimes I'll do in a growth account is say, I like to keep just a little bit in bonds, whether they're high yield bonds or a total bond fund, because I like the ability to if the market does something ridiculous, like if we have a bit of decline, I'm able to shift over and go, oh, well, I see maybe an opportunity over there because that asset's really cheap. Let me just buy a little bit of that. And then if I see things that really just inflate and take me out of my risk zone, I can sell out of that and move over to the bonds. And I can really balance that way. And then in the intermediate term, you could use value stocks, dividend paying securities. Those are great. And you can always shoot off those dividends to buy more of the growth stuff. So there's a lot of ways that you can use this to structure just about any type of portfolio that you want. We talked about diversification, how important it is to make sure that you're not being exposed to any single risk too much, making sure that you are not vulnerable to a stock, to an individual bond, or any of these types of non-diversifiable risks, or any of these diversifiable risks, sorry, and making sure that we manage our exposure to the non-diversifiable risk, mostly being interest rate risk and market risk. Those are the main things that we have the most control over. So we're going to start going a little bit more into the practical applications of this. We talk a lot about just kind of the idea and the theory, but there hasn't been a whole lot of here's what you could do practically in a scenario. So we're going to talk about that a little bit. So sure, go ahead.
Stock market went down yesterday.
Sure. Honestly, I don't really, I mean, tariffs are a big reason, but possibly. Yeah, I mean, it comes down to the decisions of the people who hold the shares. So it's hard to say exactly what event is causing something unless we have a really direct causality relationship, because at the end of the day, it just comes down to, sometimes it can just be fear. I mean, sometimes the stock market reacts with seemingly no news and it just declines because people are scared of the circumstance. So these short-term fluctuations, to me, you hear a lot of people really confidently say why they think the stock market went up or down. I don't think any of them really have any idea. No, I really don't think that most people have an idea of why the stock market goes up and down on a daily basis. Sure. I would say that is absolutely probably due to a lot of uncertainty in how our relationships are with other countries, for sure. But I can't say that this 1.5% was due to that statement and this 0.5% was like, it's a game that you'll just keep guessing over and over again. And then every time you're wrong, you'll be like, I don't understand. And it just, to me, I just want to zoom out. I just want to zoom out. And if that's not the type of volatility that I can stomach, then I'm not going to take it. So that's good.
In 20 minutes, good news comes out, the market takes off, and then you're out and you missed it. So if that doesn't work for you, don't be there. But, right, Nash reallocated the last time the market dropped a few months ago, moved some of my T-bills into equity blue chip stocks, so they're probably doing reasonably well now, right?
Yeah.
The growth stocks are down, so we'll probably do that again and go into the bottom of the growth stock area, prefer funds for the diversification. But go back and look at the charts. I mean, the market's up 1% or about 1% since the year to date, so it's not down that much. But if you think this is anything, remember back in 08 and 2020, in a day we saw the market drop 1,500 points, and that was back when it was only, it's like almost 10%. So we don't know what happens politically. We don't get involved, but we do know that if you get off the train on the milk run and you're on your way to Reno, and you don't get back in time, you miss the train. So if it's a real big discomfort, maybe get out altogether and then decide what way makes you feel comfortable. That'll help you go along.
Absolutely. So in the big picture, not every single investment account, not every single little piece of the portfolio has to have all of these 3 distinct stages, but they could be a piece in your overall portfolio in which they are a stage. You could consider something like an emergency fund to be a short-term cash vehicle. And then you could assume that something like maybe like a Roth account is intermediate term, where you can still pull the principal, but you are holding on for that growth, versus something else like a 401k, where you put your money in and it's locked up and you can't touch it. Obviously, that's going to be a long term if you're a working employee. So all of these, any sort of piece of the investment puzzle can fit into any piece of the stages. It just depends on what the objectives are. So knowing the purpose of the account gives us the framework to build a proper portfolio. That's why when I talk to clients, especially when they have multiple accounts, I like to go, all right, before we really start thinking about what we're going to put in here, let's give names to all of these. Let's determine what these are going to do. If they've got a Roth account, usually I say, let's crank up the risk over there because we get the best tax benefits for the growth. If we have accounts that have to do distributions, RMDs from IRAs and qualified plans, usually I say, let's go somewhere in the middle so that we have something to pull from for distributions, but we also can participate. So if you don't need to take out extra, we let it ride. And then if we're looking at something like a taxable account, maybe I'll say that's more conservative because we don't need to be generating lots of capital gains. We don't need a lot of much really, and we can just generate some nice tax preferred income. So to me, it just makes sense to say this portfolio is for that, this portfolio is for that, and give really designated purposes because it just makes it really easy to choose what goes in there. And when you watch the performance of that account, understanding that if you're looking at this is my growth account, you see it drop by 15%, you go, ooh, yay, it's on sale. And then you can not feel so worried about that versus if all of your accounts are the same balanced allocation, everything drops by 1% or 2% and you just kind of don't feel so great. Versus if things are segmented and you look at another account and say, wow, that one's down a lot, but the account that I need to pull cash from hasn't really felt much at all. It might psychologically feel better, even if mathematically it makes no difference. So that's just kind of how I like to look at it.
Purposes of growth. You know, just like you said, cash.
Yeah, so that can be, but usually when I'm thinking about purpose, I think of like what is the money going to do? Like, what is this for? So a lot of times if you have a person with a bunch of different accounts and they've got a little Roth account, I'm going to say, let's let that be for the kids because they're going to get the best tax benefit out of this. They're just going to get a big lump of tax-free money and they don't have to think twice about it. So that's a really easy way to segment that off. Versus if you have a big taxable account and you can make it conservative, a place to put and withdraw cash, then it makes it really easy to determine that that's going to be a conservative portfolio because that's where you're taking money in and out of. So I like to think of it as practical application. What am I going to use these dollars for? That really quickly gets me to the right allocation because I can think of time frame, risk, and all that sort of stuff really easily.
It's also what the media focuses on. QQQ is a tech stock fund, right? It's a growth fund with more tech. It's down 3.5% year to date. But the index that you always reference, the New York Stock Exchange, is up 2.6% year to date. Where's the median? So if you're allocated properly, if you're watching the news, the S&P owns about a third in tech stocks and other ones, and that's down a fair amount. But the New York Stock Exchange is up almost 3%, and we're on top of that.
Yeah.
You are.
Yeah, I mean, I look at my portfolios and I keep getting shocked that that one dividend fund that we use a lot, like I just keep like, wow, it's still not down yet. Like it's still doing all right. And even, yeah, even from the peak, it's maybe, I think it's down 0.5% versus S&P being down 6. So
Long term be the hero. S&P probably would be the 500 biggest companies, but intermediate to short term, if you got to manage the emotions, I have most of my stuff in value stocks with dividends and things. There does when the S&P takes off, you got to give that up. But when it drops, I just feel so much better on the downside. But we don't make as much. That would be good too. And if it's got growth funds in it, make sure they're getting dividends or getting added to, or have somebody add to it, because we're counterintuitive. When the market tanks right now in growth stocks, if you have somebody rebalance it, whether you do or somebody else, it's a good idea to move some stocks into the growth area. We could be flat out wrong and it drops again. Okay, go feed the horse again, give it a little bit more money. And in the long term, we have faith that growth stocks and technology will come back, but there's no guarantee of that either. That's the fun of this game. That's why he plans out short-term, long-term, short-term, intermediate, long-term positions. And therefore, the worst case scenario is you need some money. You're already positioned to have the cash, or the funds that take a little bruising intermediate. In the long term, make your commitment and make your stand. If it's not what you want to do, try to get out before they.
Yeah, exactly. So we're going to do a couple examples for lateral integration. We won't be talking necessarily about specific funds or anything, but we'll just kind of give you the more specific categories. And this will be an example for kind of your standard balanced middle of the road person who basically, this is for somebody who's a moderate investor, balanced objective, and we're just looking to distribute consistent income from a retirement account. So just think when we're looking at all of the things included in here, I'm thinking of probably like somebody with an IRA and they're starting to take RMDs. They probably want a little bit of growth to continue growing the assets, but they still need to distribute money. So that's kind of like just the perspective that I like to look at account building in for like an example. Then you can always tweak things one way or the other from there. So when we're looking at stage one, usually we're thinking about the first 0 to 3 years of use of money in the portfolio. So we're thinking of securities that can be liquidated quickly with little to no loss. And usually that no loss means cash, like just actual cash. Don't expect to be buying an S&P 500 fund and have no loss. We're looking for the least aggressive possible things that are just simply very, very low volatility, maybe a couple percent at the most. But we're looking at cash and cash equivalents, ultra short and short-term debt. So we're talking about bonds that are up to maybe 2 or 3 years in what's called duration, or how long, basically, it's kind of a factor of how long the bond lives for and its interest rate. So we'll have things like treasury bills in there, so US government debt that lasts for a year or less, and money market funds, which are just a combination of a lot of that 1 year or less maturity debt. So it's very liquid. Usually the share price doesn't change. Sometimes it'll change by 1 cent, and it's usually tried to be pegged to $1 as close as possible. But the volatility on these things is really, really low for the most part. I think it was a little bit over. It was close to maybe 3 1/3. I think something like that, maybe a little bit lower.
If you want to park some money, Vanguard, JP Morgan has an ultra short-term federal municipal.
Yeah, there's a couple of those which are nice. So in the next stage, usually we're looking at the next 3 to 7-ish years. And these could be, kind of vague. You can determine your own if you want, but these are kind of our guidelines that we start with. And so we're looking at possibly longer term debt securities. So we might be extending that duration risk a little bit out, but not so much that we're ridiculously exposed to interest rate risk. And then we're looking at index funds as well. So we're looking at things that are very broad-based, kind of just when you hear stock market performance, that's basically what we're expecting in the ups and downs of these funds. So we're looking at funds that usually would suffer more of a loss than the ones liquidated in stage one, but usually they'll recover with dividends over time. So this can be kind of a lot of different things. It really depends on where your risk sits. Because for the most part, I mean, you can have things like S&P 500 index funds, but if you're a little bit more risk averse than that, you might save that for later and stick it in stage 3. A lot of the times we might think of 3 to 5 year government bonds, maybe high credit rating corporate debt. So good, well-rated corporations and their bonds, short-term bonds still, and maybe we'll use something like preferred securities or other dividend-focused investments. When we move up to the stage 3, which will be 7 to 10 years plus, like we're talking about, really just want to throw it out there and wait a while. These will be the securities that are held for long-term investor objectives and goals. So this will be the most aggressive things. Usually it's growth oriented because this is where we want to see that expansion. We want to see that capital growth. So we'll see things like growth stock funds, longer term bonds, because when interest rate markets get a little squirrely, so do long-term bonds. So we usually like to keep those toward the end because we don't want that to drag down our portfolio by too much. Junk bond funds, so high yield, things that are not rated as highly by S&P and Moody's and whatnot. Usually they'll pay much better interest rates because they're compensating you for the risk of that lower credit rating. And then you might include your speculative investments. So if you've got some concentrated sector funds or individual stocks, this is where I would think about their placement in your plan. So if you have individual stocks, that's fine. Just understand that you want to push them off to this stage 3 to make sure that everything else is much more broad-based, much less individual risk or unique risk to that company. So think things like small cap, mid cap, large cap growth factor funds or index funds, high yield corporate and municipal debt if you're looking at a taxable account, and a lot of your concentrated sector funds. So if you've got like a big tech fund, really strong tech holding, or healthcare, or some other big sector, really just kind of, we want to stay more diversified in the earlier stages, because again, we don't want a certain sector to, like if utilities just crash by 50% tomorrow, that's probably not going to have nearly the effect on the S&P 500 or a big index fund across multiple sectors than the utilities sector fund would feel. So those unique risks we want to push over here into this last stage. Now, with that, each investor will have different goals and desires. Everybody thinks about things in a different way. You might have two people who have the same risk tolerance, but they might have, different ideas of how to get there, or different ideas of how they feel about their investments. So for each different investor, there will be a different asset allocation that makes the most sense for them. And we'll mostly focus on things like risk, because that is the most objective thing that I can look at between different people. But you'll also have things like social preferences, like investing in what you believe in. And that's also a great way to filter. So these different investor profiles will help us influence our choices for the funds in each allocation. It'll help us really decide what goes in stage 1, what goes in stage 2, what goes in stage 3. So we'll look at a couple examples of what those profiles might look like and how we might begin to choose things for each of them. So we'll start off with a conservative investor. So this person desires low volatility. They have a bunch of immediate cash needs, so they need a lot of stable assets to pull from, but they want a little bit of growth just for that inflation protection, just to make sure we're not just straight up losing 3% a year. Make sure that we are growing a slight amount of the portfolio kind of over on the side to compensate for some of that loss to purchasing power risk. So if we look at the 3 different stages, I've labeled them to kind of think about what perspective we would look at each of them for. So in our stage 1, we're going to be looking at our immediate needs. What are we going to pull cash from? Like, where is the money going to come from? Versus the next stage over is our low volatility, but yet a little bit more, compensation for the risk than stage 1. And then in stage 3, we have inflation protection. So for that piece of the puzzle, to make sure that we are protecting ourselves against inflation a little bit, that's where we're going to put some of these higher risk funds. So starting at the beginning, in stage 1, places that we can pull cash from, ultra short and short-term US government debt. Like I mentioned before, we're talking about 2.5, 3-year duration. Money market mutual funds, pretty much cash and cash equivalents. Stage 2, we're looking at things like maybe some intermediate term US government debt, couple years out, 5, 6, 7-year duration. Maybe we're looking at government agency bond funds, so possibly things like Ginnie Mae's and Fannie Mae's and stuff like that. So next we might have investment grade corporate debt. So we're talking about high grade corporate debt, but that's still going to compensate us a little bit more than those government bonds, because in the market, it's kind of, again, it's one thing that I am kind of shocked I'm always allowed to say, but US government debt is considered guaranteed. Like, I could actually legally say that, even if, you might not think so much about the federal agencies at whatever point in time. But we like to use those high-grade corporate debt to give us a little bit of extra compensation for that risk. And then when we move over to inflation protection, that's when we start using our broad market index fund. Total stock market, S&P 500, maybe using some balanced funds. Vanguard has some pretty good ones. Value and dividend funds. So things like US dividend securities that pay out a good share of their profits. That's always nice because those can get reinvested over time. So this is kind of how that conservative investor would be spread out. Yeah.
Got index funds,
Yes.
but I missed it when you talked about value dividend funds.
So that's kind of like, that is part of that passive strategy where you can have a dividend index fund as well. So there are indexes that represent companies that pay a lot of dividends or what are called value companies. So
Index fund called dividend index.
yeah, you can have a dividend index fund or you can have a dividend factor fund. Really just the idea is the fund focuses on finding a company that pays a reasonable dividend.
And
There's some ETFs out there that are called the S&P 500 high dividend,
Yeah.
S&P 500 low volatility. So they specialize more with picking out the high dividend stocks of the S&P and leaving the tech alone.
I think the S&P 500 index funds invested in all 500, but you mean these only invest in maybe 100 of them?
Right.
Right. So that would be an example of a factor fund. So it's looking at the index and then it's using determined factors and saying, now we're going to pick out of that.
Yes.
They just say S&P because that's what they're referencing and then they're choosing from that.
That the dividend fund, I realize that it's being reinvested, but how is that better than a regular index fund?
It's not necessarily better. It's just a different type of company. So oftentimes so the difference between growth is a growth company is continuing to make its place in the marketplace. It's trying to take more market share and become a big player. A dividend stock is a big player. They're there for the long game. Like they've been around, oftentimes you'll hear the term blue chip stock because that's just a big company like Coca-Cola is probably not going to go anywhere for a long time. And they're going to pay dividends and they do pay dividends. So you might, yeah.
Microsoft is also that stock. Used to be a tech stock, growth stock, but now it's leveled out. It's pretty big and they of course hope to grow, but they're not taking the high risk for growth.
Right.
So the difference between the S&P 500 and the S&P value dividend fund,
Yes.
that the difference is that growth thing could go much higher.
Yes.
But this
Sure.
one's gonna get dividends, but it's not gonna ever jump like 10%.
License this person, we need another advisor.
Yeah. Yeah, that's
Yeah.
basically it.
Go up to 15%.
Right, exactly.
But it's probably never gonna go down.
That's the hope. Yeah. There you
That's
go.
my, that's right.
And there's funds out there, right? You've got tons of them that
Mhm.
do exactly that.
Yeah, so there's a lot of things that you can do. A lot of the big companies will have really good dividend funds. And actually, if you look right now on the charts and compare some S&P to some dividend funds, the dividend funds are holding way stronger right now, mostly because the tech stocks are just sliding. And, there's a lot of sort of infrastructure there with the tariffs and all sorts of different things that play into that. But those value stocks are holding a lot more value right now, as they usually do in times like this.
But it was good timing. Now we might move those back in growth now that growth is down.
Yeah, growth is down a lot.
Down a
Yeah.
lot. Okay, yeah.
Yeah. yeah.
The value is dropped, so.
Mm-hmm. Yeah, it's pretty good. So that's our conservative investor. And now we're going to move over to a more moderate investor. So this will be kind of that middle of the road, has some immediate cash needs. Maybe they need a couple distributions. They want to get some strong yield. So for stuff that doesn't move a whole lot, they still want to get compensated for their time. And they desire a little bit of growth on the other end, beat out inflation, but also just continue to grow the portfolio over time. So for that person, you'll see some of the more similar funds, but you'll also see some new things. So you're still going to have your money market mutual funds because those are always a great place to hold cash that's going to get distributed. You're still going to see short-term government debt, but you're also going to see short-term managed bond funds. These are going to be a little bit more expensive, but in the bond market, there tends to be, on the whole, there's more inefficiencies in bond markets. Stock markets are hyper efficient. Like it would take you a lot to find an opportunity that somebody else and 1,000, 10,000 other people haven't already seen. Like the data is already out there just like that. But because it's not traded quite as liquidly, it's not it's not the same amount of back and forth and just hyper efficient nature. The bond market has more opportunities in it. So we can see that management can do pretty well, and they can also shield us from a little bit of volatility from interest rates or different things like that. So because we see that long-term managed bond funds actually have done pretty well in comparison to some of their index counterparts, we start to include those. So that's for our cash needs. We make sure that we have our short-term managed bond funds, our short-term government debt, and money market mutual funds. As we move over to the next stage, now we're thinking about that income portion. We're thinking about the yield. How can we generate yield? How can we get some cash flow out of this thing? So that's when we're thinking about preferred stock funds. Now, preferred stocks are kind of like a little bit of stock and a little bit of bond. They have some characteristics of each, but generally they're preferred because in the event of something like a bankruptcy, they come right before the regular stock of the company. So the preferred gets paid first, and then if there's no money left over for the common shareholders, sorry. So you get a little bit of preference there, but they tend to pay out higher dividends than dividend stock funds or other normal stocks. So they are a good place to generate some income. Then you'll also have your dividend stock funds, as usual. You might have high-grade short-term corporate debt to get a little bit of extra yield, and some high-yield short-term bond funds for that little bit of extra risk, but a little bit of extra return. That's where I'm kind of seeing right now, we're still hard pressed to find a reason to go for longer term bonds, whether they're corporate or government or really anything, because the yields just still are not that much better versus all of the extra interest rate risk that you're taking on. So we've been looking closer to higher yield bond funds and corporate debt and stuff like that, just because you still don't have as much sensitivity to interest rate changes because the term on the bonds is shorter, but you get compensated a little more for the lower credit rating. Then as we move over to stage 3, we're giving this the purpose of growth. So we're throwing in our low-cost stock index funds as usual. We're throwing in sector funds and maybe a bunch of growth factor funds. So things that we expect to be a lot more volatile. We're pushing over into this growth stage and allowing them to do their thing over the long term. So next, we'll take a look at an aggressive investor. So this will be somebody who really doesn't have cash needs. They want a lot of growth over a long period of time. We're really just trying to sit through these periods of volatility and take advantage of the averages over the long period. And they're willing to withstand that significant volatility. So this would be somebody like me. That would be my profile. I'm an aggressive investor because I don't have cash needs for this, and I want to see my 401k or my IRA grow a lot over time and really hit those big values for retirement. So somebody like that will have something that looks a lot different than the previous two people. We're going to have more of those high yield bond funds. We might have some fun derivative income funds selling options or using synthetic securities to generate income and all tons of complicated stuff that would take me way too long to explain right now. We might have high dividend stock funds in there as well. And we're looking at this for high yield. You see, it stops being a cash position because the cash is, this account doesn't need cash. This account can have some lower volatility holdings for opportunity buying, because maybe I can sell out of the high yield and go buy an individual stock that I really like. When we move over to stage 2, then we can think about broad growth. We can think about small, mid, large cap stock index funds, get me all that cheap exposure. We can think about the growth factor funds where we have those strategies that are trying to really get as much growth as possible, but end up being super volatile. We'll think about international stock funds, which we'll touch on their use a little bit more later, but right now those look pretty good. They're doing pretty decent in comparison to US equities. And then as we move over to stage 3, that's when we just start getting fun and speculative. If you've got an individual stock pick, here we go. Alternative investments, super concentrated sector funds. This is where we can start to take a lot of additional volatility on top of what we're already doing because we know this account is for that growth purpose. So kind of going back on that. Yes, sure. Yep. Mhm. So alternatives, we're usually looking at things that are not your classic stocks or bonds. So we could be thinking about like all limited partnerships, something that's not a publicly traded investment, something that you're getting into privately. You might think about commodities, stuff like that. Yeah, real estate would also be part of that. So any of the things that are just sort of not your classic stock and bond mutual funds and all that kind of easy stuff, more alternatives get slotted in over there. So kind of going back on all of that stuff that we just did, we're thinking about stage one, for the most part, provides instant cash and stability of assets. But we can see that when we move to somebody like an aggressive investor, that could be changed. The purpose for that could be slotted to something else. In stage two, for the most part, we're designed for intermediate liquidity. So if we need to get something in the intermediate term, we can still pull from it. And there's not so much of a risk that it's going to be wildly up or down. Modest risk and intermediate term horizon. So several years out, but we're not needing to wait 10 or 20 years for the numbers to go in our favor. And finally, in stage three, we're designing these holdings for long-term results while continuously experiencing short-term volatility like we're experiencing right now. So those sort of assets that I see when I see like my large cap growth factor fund down 10%, whew, that hurts in the short term, but over the long term, I'm hoping that that plays to my favor because that volatility should swing back the other way. So next we start looking at what we call vertical integration. So we've talked about how we're going to use our time horizon to select different types of investments, but now we're going to look at our vertical integration and how we can start layering different investments in each of those places. So we've got three different levels on here. We've got the bottom here, and you can see as we start to move up, they get smaller and they get smaller. So level one is our biggest, most allocated to position that we want to make sure is really, we're biasing our entire portfolio towards that. So level one consists of really low cost investments. So our purpose here is to just try and participate in overall market trends. So if this is stage 2 or 3, we might be thinking this is where an S&P fund is going to go because that's going to cost us barely anything to hold. We won't even notice that we're paying a fee. So we're seeking same as the market performance from these assets, whether they're stocks or bonds. We just want to be not looking for additional performance or additional risk. We just want to participate in the cheapest way possible. And so we're looking for funds that have very little unsystematic risk or diversifiable risk. These are the type of funds that we want to hold tons of different things in there because we're not taking extra risk. We're not paying extra management fees. We're getting low fees, diversified holdings so that we're not too exposed to any individual risk and we're not paying a bunch of money for it. So there's a really strong emphasis on low cost. These will generally include your broad-based low-cost index funds. That's what usually costs the least. So we might have short-term treasury index funds, and that's super useful for our stage one. We might have our S&P 500 index fund, which is great for our equity portion, as well as just simply total stock and total bond market index funds. You'll see there's a fund that's called it's ticker AGG, and it's an aggregate bond fund. And that just means we're looking at all of the bonds on the market. Let's get a little bit of all of that and roll it up into one investment portfolio. Generally, I'm not using that a lot, not because it's a bad fund or because they don't do it right. I just don't really want to include all of those super long maturity bonds in my portfolio. I want to split that up and say, maybe I have a little bit of long-term over there, but really biased towards the short term. But this is where we really want to use those index funds. So even if you're sitting in stage one, index funds for the short term, super low cost, in and out, short-term treasuries. Maybe you move over to stage two and you think, maybe I can get an intermediate term treasury index fund. Maybe I can get a short-term high-grade corporate debt index fund, or maybe some total stock market, and then include maybe some S&P index, growth index, small cap, all sorts of different things, but making sure that we bias towards low cost. And the reason that we're doing this is because one of the biggest detractors of performance over the long term, for the most part, is fees. It really is. If you look at like a growth fund, for example, that charges you an exorbitant fee, you're going to be very hard pressed for those funds to beat out something like the S&P 500 that cost you a couple percent of a percent. So if you want to pay 0.6% or 0.7 or 0.8 to whatever fund manager you think is going to do great, that's awesome. But you're probably going to be just as well off, if not better, just going right into an S&P 500 index fund, paying a couple percent of a percent and letting that ride for all of that time so that those fees don't take out of your yearly performance. So we'll look at what are a couple examples of what might be inside of that. So here are specific funds. Now, they're just here for discussion. I'm not making any specific recommendations of these individual funds for your use. I'm just showing you examples so that you can look at these and understand how these are fitting into all of the things that I just described and how you might be able to choose your own. So starting at the top, we've got one ticker FSKAX. This is a Fidelity fund, and it's a total market stock mutual fund. So they're just looking at the stock market and they're saying, give me one of all of it. Just give me one of all of it. And they're going to weight them based on how big that company presence is in the stock market, just like the S&P 500. And they're just going to try and get a little bit of all of those different funds. So you remember how we had that conversation about company risk? We started with one stock, there was market risk, and then a whole bunch of company risk, and we went to 10 stocks and it went down, and then we went to 100 and it went down way further, and we went down to 1,000 and it was almost nothing. Well, this fund has 3,850 stocks. So we're taking care of that part of the diversification, signed, sealed, delivered, like not even a question. It's that diversification is done. We don't need to worry so much about individual stock risk with a fund like this. And it only charges 0.015%. And a percent of a percent, which is what that one is, 1.5% of a percent, that's called a basis point. So I'll start referring to fees and stuff like that as basis points. Just remember that a basis point is 1% of 1%. And because these numbers get so small, it just becomes more convenient to refer to them that way. So the next one is, I believe, the second most popular S&P 500 ETF that exists out there. And it's from Vanguard, and it's ticker VOO. And it's a S&P 500 ETF from Vanguard with a fee of 0.03 basis point. And you know what, or 3 basis points, 0.03%. And you know what? I am actually curious because I remember they had just made an announcement recently about how they slashed all their management fees. So I'm totally curious if that one went down at all. So I just want to see for myself. Yeah, so they've been, okay, this one looks like it has the same fee, but they, what they did was they made an announcement saying that all of their management fees for their funds and mutual funds got slashed a lot. So any of their higher expense products now cost less to be invested in. And I think their average, they advertised that now their average expense ratio on mutual funds and ETFs is 0.07%. I'm not sure if that was what it was.
They used to have several that were lower, but they added new funds. So when you add these factor funds, they came in at 0.15, 0.25. So they're the new funds that had higher costs that were more specialized, and they're still low for the industry. They now equalize them down to the lower index. So it's like taking on a lot of new inventory to sell the public. Now that you're getting the scale and numbers, you can bring the cost of those funds down. So like in that fund, it didn't drop, but the other ones that were newer that were 0.15, 0.20 have been brought down. And that's what Vanguard does, is it copies something. And if it gets popular, then they'll scale the price.
Yeah, so if you want those really inexpensive funds, Vanguard is great for that, yes.
You said this is the second most popular S&P 500 fund. Is it because of that low expense ratio of 0.03?
Yeah, I would say that's absolutely one of the reasons why it's so popular. And Vanguard is probably the most recognizable name in, mutual funds and ETFs. That's kind of like what everybody thinks of. when they think of it.
Yes, it's have the same thing.
Mhm.
So it's the same thing, but this one just has a lower rate. Lower fee.
Yeah, a lot of these funds,
Good name.
yeah. Yeah, and a lot of these funds have similar low fees, but it's just because this company is so large, they're so prevalent in the space. Everybody knows about their S&P 500 ETF, and so it's a really common pick.
Which gives you micro better returns, tiny bit better. That's not to notice. Is it SPY? Is that the other one?
Yeah, SPY would be the number one.
What's their management expense?
If I remember correctly, they lowered it the last time that I looked, but it's still very low. I think it's within a couple basis points of this. Let me see. So that's from SPDR, and their management fee is 0.095. So it sounds like a lot more than this, but you're still dealing with less than 0.1% per year. So, well, I mean, let's see. This is $575.92 a share, and the Vanguard is, let's see, it is $529.51. So
But
pretty comparable.
the price doesn't matter. It's
Yeah.
The number of assets of people and all that same value. But SPY's been around. They were one of the first S&P.
Yeah, they were.
And they're just not willing to drop their fees down as low as Vanguard.
They probably just don't have the same volume.
Yeah, they don't have, they can't scale it, so that's. what
Actually, no, they do have
Vanguard
volume.
doesn't come in like another country, and take over. So, but that's great if you're a buyer and holder of Vanguard funds, but some of these others that aren't as big can't afford to do that.
Yeah. So next up on our list, we've got ticker SCHO, and this is a fund from Schwab. This would be a short-term U.S. Treasury ETF with a fee same as VOO of 0.03% or 3 basis points and close to 100 individual notes. Now, because they're short-term treasuries, I mean, it's kind of hard to diversify that much in short-term treasuries, but you just have a lot of those similar investments so that we can get that average of the yield. And it's one of those great options for stage one. So if you're looking for something to hold some cash in, it's not quite a cash equivalent, but it's pretty close because of the short-term duration, and it's pretty inexpensive. So that's something that looks like this is what you'll want to put in stage one.
And every time they mature, we gotta call them, it's maturing, now how
Yeah.
many months? But a fund that they have available, it just keep rolling it over, and it takes a while.
Yeah, that was actually something a while ago. I had a client who they like to buy a single treasury, let it mature, and then buy another one, let it mature, buy another one. And I just, the one of the times that we were talking about, I was just like, I just like, we're trading this so often and I feel like we're not getting that much extra out of it. So let me just pull up the other ETF and compare the rates that we're getting. And they were basically the same, if not sometimes ever so slightly higher. So I just said, hey, can we just put it in this ETF? Because we're getting the same yield anyway. And we're like, oh, okay, we can do that. And we don't need to trade in and out and have one individual bond the whole time. It also increases the liquidity. So if you need to buy and sell out of it, it's much easier to just effect that sale immediately and have the cash at your account. Yeah.
State tax, right?
That is also true for the ETF. Right.
I mean, you don't have to liquidate the whole T-bill with your money. You can
Right.
shares out.
Yeah. So that's one thing that is really nice about ETFs and mutual funds is for whatever asset is in there, you get the same tax treatment, even if you're holding the ETF. So that's pretty nice. That was another reason why I was just saying, let's just move over to this ETF. You get the same tax treatment, you get better liquidity. You don't have to sell the entire treasury bill. You can just sell a little bit if you need it. And we're getting basically the same yield anyway. So it was one of those things where it's just like, we don't really need to be doing this individual trade. Let me just get over here.
I think I've got it. I didn't understand what you said, that which one doesn't get taxed? Is it the second one?
Treasury, the treasury.
So treasury bills, treasury bonds, those you don't pay state tax on the income from them.
No state taxes.
Yeah. Yes, still federal.
And Be careful with those, because you might have a mutual fund that has treasuries in it, and you're not gonna get them state tax free. It's gotta be, I'm assuming an ETF. I don't know if it's the same if it's.
No, I think it's the same.
On a mutual fund.
Yeah.
Have partial treasuries in there.
Well, the income that's attributable to them will most likely
So
be.
you're pretty sure about that?
Yeah.
Okay.
So next up on our list, moving down. Oh, sir, you go ahead. Go ahead.
You said this, the third one is good for your cash.
Yes.
having Cash available. Are the other ones on your, how volatile are those?
So these are going to be some of your more volatile. They're not going to be quite the same as super heavy tech or growth stocks, but this is going to be sort of that average of the stock market performance. So if you,
The second,
yeah, both of those will be very similar.
yeah, last,
And then the last one is a total bond market index fund. So you'll get, this will be a little bit more volatile than this one, but much less volatile than these two. So this would be kind of middle ground. So I'm thinking stage 1 for the third, stage 2 or 3 for the top two, depending on your risk tolerance. And then this could be stage 2 as well. So this is really just kind of like, you get access to a whole bunch of different bonds. So as you can see, there's over 17,750 individual bonds in there. So you get a lot of diversification. But again, the reason that I don't use a lot of total bond market index funds is because of that extra risk when interest rates change. The bonds are super long, so that makes them fluctuate in value a lot more. So that's why generally I'm not putting a lot of money in a total bond market fund, maybe an active one where there's a little bit more control over it, but not necessarily an index fund where I get no say in what's happening inside there or the manager doesn't do anything. So moving up to our next part of our little pyramid is the midsection, level 2. So this is where we're maybe going to get a little bit more targeted, but we're not doing anything crazy. We still want to pay a little bit less in management fees. We don't want to get super expensive, but we're going to get maybe some more targeted exposure in equity and bond categories. So wherever we're looking at, we're going to start maybe looking for some more interesting funds. We might be looking for higher yields from income or some more managed risk. We might be looking for more targeted exposure for growth or a bunch of other strategies that align with what we're trying to do. So this is where factor and sector funds fit in really well. So if we're looking at bonds, you might see, I don't know, we're looking for some sort of, maybe a little bit of more active management, but we're just looking for those shorter term bonds. It's not just an index. And if we're looking at sort of our growth and value sector, we might be looking at some funds that do some extra things to try and cherry pick a couple stocks that might either get a ton more swing in growth or they have really strong dividend yield or low volatility over the historical timelines and all that sort of stuff. So this is, again, those passive but not straight up index strategies tend to fall. So we'll look at a couple examples of that. So here's 4 funds that fit into our level 2. And the top one, which if you'll look, this one's down a lot right now, is a large cap growth ETF from Fidelity, ticker FELG, and it's got a fee of 0.18%. So we notice that that's a decent amount more of a fee. It's still not a high fee by industry standards, but they use quantitative analysis. So they look at all the numbers of all of the companies. They might be looking at financials or a whole bunch of other different stuff, but they want to assist themselves in choosing stocks for growth. They want to look at something like the S&P or the New York Stock Exchange and go, okay, what stocks have the greatest potential for expanding, taking market share, and becoming bigger players in the space? This tends to also give us a lot more volatility because companies that are likely to expand are also sometimes likely to fail at that and contract away from being a big player. And a lot of their share price is simply determined on what the expectation is moving forward. So you can see that in a lot of tech companies where they don't pay out value to you. So you're not shopping for a dividend. You're just shopping for them to get bigger and bigger and bigger. They might, suddenly hit something where if there's a tariff that's going to make it more difficult to import chips, then you start to see a little bit of sliding in performance because the expectation for what's going to happen starts to slide down. So this is one of those ones where long-term, it performs super well, but you also got to understand that the risk goes up as well because you're narrowing that choice to fewer funds or fewer stocks. So moving down from that, we get to HDV, which is a high dividend stock ETF from iShares with a fee of 0.08%. Now, because this is not really a difficult strategy to do, it's still offered at a very cheap price, 8 basis points, still practically nothing. And they just basically look for what are those nice big companies that pay solid dividends. Put them in a list, there you go. So if you want stocks that pay dividends, something like that could be a good choice. Another alternative is SCHD from Schwab. That's one that a lot of people really like. If you just kind of look around on the internet, that's a favorite of a lot of people, and I've used it a bunch before. Moving again, we get to our first sector fund, which is FUTY, and it's a utilities index ETF from Fidelity, which is pretty much exactly what it sounds like. It's an index fund that represents the utility sector. And I know you've had a lot of experience investing with this one long-term in the past.
Yeah, you'll find utilities to be a volatile stock, right? But they historically have a fairly good dividend, maybe 3.5%, which doesn't sound like much. But a couple of years ago, when rates were down at 0.25%, that was pretty nice. And then you see them go up 45, 50%. We were buying them for the non-correlation to the overall stock market. Some of them, they can go up or down the same, but for the dividend.
Yeah. So again, this one's pretty inexpensive, 0.084%. So you're not paying too much for that exposure because again, it's an index fund, but it's a sector index fund. So it's a little bit tightened scope of what we're looking at in the market. So it doesn't give you quite as much broad diversification and can be a little bit riskier depending on the economy at the time. So next from there, we're moving on to ticker IWS, which is a mid-cap value stock ETF from iShares with a fee of 0.23%. So now you can see we're kind of layering multiple terms into a single investment strategy because we're narrowing the scope to mid-cap stocks. So, okay, now stocks that are this certain size. Now within that, we're gonna say, I just want the value stocks. So now we're gonna narrow that scope. Then we're gonna cherry pick out these stocks and make an ETF of that. So that's what that can be. I like to sometimes, if I'm looking at like a growth portfolio or something, I like to have a value for each, value and a growth for each size. So small cap value, small cap growth, mid-cap value, mid-cap growth, large cap value, large cap growth, because you can kind of see like which part of the market is moving more and you can decide, oh, is small cap growth the one thing that's just being hammered by whatever's happening? Great, I'll just specifically buy a bunch of that. So that's kind of a fun strategy to do if you like rotating like that. So now that we're done with level 2, we'll step up to level 3, which is the very, very top of our portfolio. And this is where we're looking to do maybe a couple different things depending on what stage we're in. We could be looking to take much higher risk than we would in the overall allocations below it. So if we're sitting in stage 3, when we get to these smaller positions, we might be looking for some management to do something extra. We might be looking at our alternative investments. We might be looking at individual stocks, just different things that we can't so easily get for a super cheap price down below. So we're willing to pay higher fees for very particular strategies or management teams. So like I mentioned before, in those bond markets, there have been some management teams that do really, really well over time. PIMCO has a few of those. Dodge & Cox has a few of those. Cohen & Steers has a couple of those. There's a couple of these big management firms that have done really well in the fixed income sector. And then sometimes we've got fancy strategies that just cost a little bit more because not a lot of people are willing to do them. For example, derivative income is something I've just kind of lightly mentioned, where they're using these extra complex types of securities to generate income that you wouldn't otherwise get from holding a stock. Now that introduces a whole bunch of other technicalities, but it's just something extra that people are doing that has just a little bit different type of performance, a little bit different than anything else you can get. And so because of that, you got to pay a little bit extra of a fee for them to do that task for you. So these allocations, for the most part, we keep them really small. We want them to be small because we're taking a little bit of extra risk. So if that extra risk ends up being what we fall victim to if they fail or something really tragic happens in the very specific sector that they're in, the overall impact on the portfolio would be minimal. But if they succeed, maybe we get a little bit of extra return or some non-correlated returns. So if we just have, a managed fund and they go a different direction than the small cap or whatever index fund is doing right now, and they go a different direction, and the overall market just crumbles, but for whatever reason, what they're holding does okay, that pads our volatility a little bit. They may continue on the way up or not so much, but there are things that can help. So that's going to include things like well-managed funds, maybe defensive management techniques, super volatile or sensitive sectors, or the best performing managed funds that might charge a higher fee than most of your index funds. So you'll have things like active stock and bond funds, derivative income funds like those option strategies I talked about, or even new sector opportunity funds. So maybe we're looking at something that's new, like recently a whole bunch of nuclear energy ETFs came out. They are not doing so hot right now, but they're a new place that potentially could be a lot of long-term growth. So there's a couple different examples of what we can have in here. So number one, we've got, oh, yes.
The broker. That's something they advertise, or how do you figure that out?
Well, for me, I get emails from fund management companies all the time saying like, oh, we just launched a new fund, like Cohen & Steers just launched a bunch of ETFs. Yeah, instead of their mutual funds, I think it was Cohen & Steers. Kind of, it's just like that new wrapper, yeah. I think so.
Every Tuesday, there's a guy that does an interview of all the people doing new ETFs. And it's interesting to learn everything, because before you'll hear about it, these issuers will come onto this podcast because a lot of advisors listen. And that's where I learned about a lot of these specialty funds a while ago. And so you'll hear the whole interview. But it's ETF.com on the podcast, and then also probably their website. And then also, if you want to go to Las Vegas next month, have an excuse, the Verify is some company that's related to new ETFs, is doing a conference there the 22nd of March, and then there'll be 2,000-3,000 investors, advisors, and managers there. But ETF.com, and is that how we look it up on the podcast? I'm not sure.
I think so. The podcast is ETF Prime, and they're sponsored by Verify.
Yes, okay,
Yeah.
so ETF.com is a website, but ETF Prime, look that up on your podcast, and you'll have the interviews of all the new ETF people. You'll know before advisors.
Yeah, there's a lot of new stuff on there. It's pretty cool.
Yeah, there you go.
Right.
Yeah. So a couple different examples of what we got here in level 3. Remember, we're looking all the way at the top, some of our smaller allocations. We've got T. Rowe Price, All Cap Opportunities Fund. So they're just looking at companies of all sizes, and they've actually outperformed the Russell 1000 Growth Index with lower volatility sometimes, but their fee's a lot higher. So you pay for that extra performance. And there are going to be some markets where they don't do as well. That's just going to happen. But over the long term, they seem to have actually performed really solidly. PIMIX is PIMCO's income fund. Now, they tend to outperform most of the multi-sector bond category peers, and they're super well regarded by analysts. They always have really good ratings, and they charge a fee of 0.62%. So you're getting up there in fees because they can charge these fees because people want these strategies. That's how they make their money. So that'll be one. This is kind of like, it's a multi-sector bond fund. Sometimes it can have these funds can have a little bit of equities. Sometimes they'll have some dividend fund or dividend stocks in there, but it's really solid. It generates a lot of yield, and it's a pretty good fund overall. Now, the next one is when we get to one of those ideas of the new sectors coming out. So back when not every single car company you knew had a electric vehicle for sale, we had iDrive come out, which was iShares self-driving electric vehicle and tech ETF. And they attempted to position themselves with companies investing in the future of automotives. and they charged a fee of 0.47%. I'll say that their performance has been less than stellar. It hasn't been amazing, but it gives you access to that new sector that potentially someday it could start coming up. Another example of these new sectors was, I remember, I think it was back when we were seeing that Joe Biden was going to get elected president, cannabis ETFs were really popular. They were looking great. They were up like 30, 40, 50%. It was great. And then just silence. Nobody talked about weed anymore. And then they just crashed. And I'm pretty sure they're still down 70% from that time. So it's just something to be aware of. When you get into those new sectors, there is that risk that, oh my God, it looks like this is going to be the next big thing. Nuclear is going to solve everything. And then they just stop talking about it. And then the funds just crash.
I thought, okay, I think I'm out of here. Don't be greedy. And so I was able to move on and not be in it. But as soon as you look around and say, hey, this is, everybody's thinking about buying this, it's too late. You have to go through the garage sale before anybody shows up and buy what you think might be there. Because if you're looking at body language and other people, it's too late.
Exactly.
I think that happened with like NVIDIA, and I kind of got caught in that, and like, I think I was too.
Could be, but it may have a good long-term view though, so maybe it's kind of like, I bought gold at $945 an ounce, and great, it's almost what, 3,000, that was a good buy, but this was 1979. So it's averaged 3%, it wasn't good. But I did buy more when it went down to 250 or something like that. Don't have a big stash, but we're just not privy to the future, and there's over 100 million investors. How can you predict what they're going to do, what the programs are going to do, what AI is going to do? So that's why if we follow the proper investment plan, then you can afford to make some mistakes and double down.
Just like, are you still in that stock?
Yeah, I left it in there even though it didn't do anything after everyone told me to get in.
Well, go with your gut. I mean, you may or may not decide to buy more. I don't know, but yeah, the thing that we liked about the funds is even if I buy a sector fund of QQQ tech stocks and I buy it at a peak and it crashes, then I can wait it out and it most likely will tend to rise because you have several different companies. But if I buy one stock and it crashes and they lose the business and they go under, you don't get a second chance. So sector funds, you could just wait around long enough and recover, but an individual stock, it's big risk, but then again, it's big reward. Right.
What's causing this stock to take a dive is the Chinese came out with the AI version.
They're not sure it's as good as they say, but it works out.
What they did is,
Yes.
they copied from their same NVIDIA chip.
Yeah.
The one, instead of 100, the 800.
Yeah.
That's all it is.
Yeah.
I mean, it's the same like that.
Yeah, but all the thought and the conversation, everything pumps it up or pumps it down. And so go looking for maybe a magazine of new companies doing something nobody's heard of before. I did that with quantum calculation, quantum stuff. I didn't invest in it, but just learn a little bit. But whatever it is that you buy that's going to be good is not popular right now.
Yeah,
It's a rebound or it's a new concept.
yeah, that's funny because that's kind of like the one good trade I'll always hold on to for the rest of my life was AMD, because nobody knew who, like back a long time ago, AMD and Intel were actually competitors, and they were head to head. They were computer chips, so it was CPUs, and so they were competitors, and then AMD just didn't really get to innovate very much, and Intel just surpassed and took all the market share. And they just held on to that for, I think, like a decade or two almost. And then eventually, AMD started talking about something new that they were going to roll out. They were starting to talk about, they were finally going to release some sort of competitor, and things were looking okay. And then they started sending out samples to different people to test, and the numbers were looking really good. And I just thought, it's about time that somebody like stood up to Intel finally. So I was like, all right, let's get in here. Let's get a couple shares of AMD. And I think I bought in at $10 a share and sold around 70, something like that. And then they ran all the way to 150. And now they're a giant player in the space. They're not as good as NVIDIA. They're not as good as Intel, but they offer products in both of those channels to a really high degree. So it was just watching, because I've always been really interested in technology, particularly computer technology. So I just understood what was at play. I was like, well, somebody's got to come in here and take some market share back because Intel's getting ridiculously overpriced. And so it was just that context where it's like, what are they going to offer that's different? And I saw value in that. I got lucky on that one. I sold it so that I could clear out some debt. Yeah, I made one really awesome decision as a young adult and a bunch of really stupid ones, so they netted out to zero. So I kind of like made up for my own mistakes. It was perfect.
If you want to try to get the best buying opportunity, it's usually the worst holding opportunity for somebody, right? It's like buying something when it drops, the holder is disappointed, but you're excited. You could get online and look at all the indexes or all the specialty funds. Let's say all Vanguard funds or all Schwab or Fidelity, and you just reverse the columns and show the ones that are down the most. And then if they're they have 100, 200 stocks in it, you could start buying whichever ones. And that would be growth or technology right now.
Yeah.
The opposite of whatever everything else.
That's actually exactly what I'm doing right now for fun is I just decided I'm going to buy all of the sector funds and then just whenever I've got extra cash, just buy the one that's down the most.
Yeah. There's, I don't know how many sectors, 7 or so, but you could literally buy energy, utilities, technology, and just go in and buy what the 2 or 3 that are down the most. And then when it reverses in popularity, because that's all that is, projected growth and what we think the company will do. But in the short term, when we buy and sell it, it's popularity based on whatever analysis people have. But right now, you would be buying what? Consumer discretionary?
Well, it depends on what time frame we're looking at, but for a year to date, yeah, it's consumer discretionary and technology.
We bought that a year and a half ago and we were way up, only because it was down 38%. So if you have some money that you're gonna ease in and like going to the grocery store, I'm gonna buy more of what's on sale.
How long did you have to wait before it reversed?
We did that in May of 23, and within 6 to 7 months, it was way up because this has a lot of technology in it and things that you don't have to buy. So when we came out of 2022, when interest rates went up because inflation was high, discretionary funds like computers and televisions and things like that had dropped a lot, and we were convinced we were going into a recession. So when we were down 38% in consumer discretion, it's hard to say, there's a hole right there, a bomb just went off, we need to buy some of that. You don't know, it could have dropped another 15. So then luckily interest rates, they raised interest rates and they brought them down a little bit and the market rebounded. And because we bought it at a 38% discount, I have clients that are up 40%.
So by your logic, technology is the sector to get into right now.
If on the stage 3 money and the speculative money, yes. I wouldn't put everything there, but it's a good time. Now it could drop again and you need to go feed your horse again and give it some more money. But theoretically, and if you look technology, obviously the future of our existence is technology, good or bad, right? So yeah, it's possible that you have a really good opportunity now. We don't know.
Yeah, this is over the last 5 days. So you can see that pretty much everything is in the red right now. S&P is down 2%, but if we expand that to a month, S&P is down further. Consumer discretionary is really hit hard because obviously it's harder for people to spend the money they don't need to spend.
Yeah, if they think a recession is coming, good or bad, anytime you change the economy this fast, you could run into a recession for a while. In the long term, it might be the best thing that ever happened or not. But that's what's happening to the markets. People are thinking, you messed with our little estuary here, things are a little different. Are we going to have a recession? And so numbers come down, which is, as Nash said, this is your chance. If it does recover, if it doesn't, then you need to add some more to it.
According to that chart there, it looks like it's already starting to recover.
Yeah, so this is year to date. So if you're looking overall, so the way that these are structured is these are all sector funds from SPDR, which are the same people who do the SPY S&P 500 index fund. So each of these are parts of the S&P broken down into their sector. So that's what sometimes they'll say is if you go to like the strategy page over here, they'll say a couple interesting things that you could do with these funds. And one of them is to look at the weightings of each of these and just put them in your portfolio like that, and then you have the S&P, but you have it split out into all of these different sectors to where if you see that something performs really poorly and you like buying at a discount, you go, oh, great, let me just buy some more of that, or, you know, rebalance however you feel. But you get to split up the S&P 500 into all of these different categories. So that's basically what I'm doing for fun, is I split the S&P into all of these, and then I throw in some like the small cap growth and value, mid cap growth and value, and then extra funds whenever I feel like having fun.
That have read similar to that they tech. So tech's brought everything down. One may own more or less. I guess if he's got a 1/3 in tech. But with
Yeah.
consumer discretionary, probably. has
Just
a lot more.
grab this.
But the other things that people might not buy are in there as well, and technology obviously. But if you had all these little sector funds with spiders or State Street, and you just sell your healthcare and buy into consumer discretionary, if you just did that, you most likely could at least reduce the risk of total loss of buying one stock.
What is consumer discretionary?
That's gonna have a lot of technology in it, but also things that are discretionary, like cars and television screens and things like that. Yeah, yeah,
And eggs.
yeah. Well, eggs are in the consumer staples and they're up 5%, so that's why, but the ones that are up the most, if you were gonna rebalance them into the ones that are down the most, not to guarantee that works. But, and there's probably a fund out there, an ETF that does that. Probably buys all these sectors and it rebalances.
Oh, yeah, there is. They actually talked about that on ETF Prime one of those days. I forget what the ticker is, but yeah, that does exist.
So there's one out there. And so if they're doing the lowest cost index sectors, because these are all little index in a sector. And even though financials are only at 2%, they're up like 35% for the last year. So, but if you find that fund, whatever that rebalances these and goes from the high to the low every quarter, that'd be a pretty good.
Yeah, so I actually decided to pull up the technology and the consumer discretionary. So here we're looking at, this one's the consumer discretionary. Yeah, this one's consumer discretionary. So we've got Amazon up at the top, which is nearly 21% of the portfolio. Tesla, Home Depot, McDonald's, you know, Lowe's, Starbucks, Nike, all those sorts of things. And if we go over to the technology, Apple, Microsoft, NVIDIA. Yeah, so you get a bunch of those.
Yeah,
Yep.
if you're gonna risk it, let's not risk bankruptcy, just risk market.
Exactly.
And so you're not gonna make all the gain in one of these stocks, but at least you're not gonna risk losing it all.
Yep. And for the most part, these are pretty inexpensive as well. So if I go over to the quote page, 0.08%. So on average, if you're paying 0.08%, you're not paying a ridiculous amount more for the sector fund than you are for an index fund. So it might be a fun way to get some different exposure if you like to weight differently in some of these. So that's pretty cool.
The energy stocks are down if you want to take the chance, and they might fall further if we develop more energy or go up, I don't know, but they have a big dividend. That's one thing we liked about the utilities and the energy, not that they're better than technology, but if they don't go anywhere, we've got 3-4% yield.
What company is included in the energies?
In energy?
That-
Let's take a look.
One,
Oh,
that one, energy.
yeah.
This one here?
There's,
Yeah.
There's fund stocks inside that sector that he'll bring up, like Exxon and all the big producers. Probably about half of the holdings are about 3 stocks. Yeah, petroleum and all of that kind of stuff. But it does have a fairly good yield, like 3.23. Doesn't sound like much, but
For stocks, that's pretty good.
yeah, and it's gonna have a lot of money in just a few. Look at that, 22% and 16. But at least if I'm wrong and I say, okay, I'm gonna buy this, and then the price of it goes down, I most likely can at least reinvest the dividend. In 3 years, I've got 9% in dividends that reinvested, and I can heal my way back at least with dividend.
Reinvested into the same company or to a different?
Into the same fund if you want to. Yeah, I mean, there's a million different strategies, because you could buy nothing but treasuries and then take the 4% that you earn in every month, buy into anything risky and volatile. You don't lose your principal and you're not scared, and you're buying on the way up and the way down. Every investor has their own pattern and own allocation that works for you. At the end of the day, you may be up more or down. We love it when the market crashes. We'll call our clients, guess what? The market's down 10. And you're only down 5. Oh, yay. But when the market goes up 10 and we're only up 5, well, we're not gonna advertise that.
You don't call them.
Yeah, no, but our clients don't want to lose the money. They want it as a savings investment nest egg. So there's more emphasis on not losing than I gotta be the one that has bright lines.
So here, as we start to sort of wrap up this conversation, I just kind of like to always show charts like this. These are super long-term charts of different types of assets. So it's really small, so you can barely see, but you've got at the very bottom, this shaded in gray area is inflation. Then you've got treasury bills sitting just above that. Then you've got long-term government bonds, and then you've got large cap stocks and small cap stocks. So I just always like to bring up these long-term charts because it's really important to sort of put in perspective the short-term volatility spikes and kind of how things happen. I mean, you can see things like over here in the 60s, 70s, and 80s, like you see a lot of this kind of up and down movement, a lot of short-term volatility. But then as you sit through that and you make it through, it recovers and it makes it back and more. And it's similar to a lot of these other things. I mean, you can barely even, it doesn't even look that wild. Here's 2008. It's a really strong decline, but it recovers. And so it's just important to sometimes back up and understand that even the most impactful economic downturns, overall, they will recover and they will come back if you hold through and you stay the course. And so that's why it's really important to section off for purpose. Like you don't need to be in super high volatility things for your cash to come back. You want to do this for growth because you want to be able to sit through that recovery period. That's why we say 7, 10 years plus for those growth securities, because you need the time to experience the downturn and make it through to the other side. So that's something that I always like to emphasize and make sure is understood. And that's why you see that the small and large stocks, they go all the way up to the top to $11,500 and $49,000 from a single dollar investment in 1926, and the treasury bills only sit at 22. It's important to understand where each of those pieces fit into your portfolio. The first year, 1926. Mm-hmm.
And the interesting thing is, this is an index. Well, back then you didn't have index funds, right? So the blue line, your dollar grew to about $5 and then crashed to 10 cents, right? But if you had an individual stock, you would have lost everything. They didn't have an index. If you had an index that you were in, you could have recovered from the 10 cents a share, maybe 10 or 12 years later, got your money back. And then if we can put you in a time capsule, that dollar grows to $49,000. But this is why individual stocks, you would have been wiped out, but today you might not be because you're in an index of 205,000 stocks.
So that one on your variable axis represents $1?
Yeah. The starting,
Mhm.
right?
Yep. Yeah, this will be $1, $10, 100, 1,000, 10,000, and
Yeah.
100,000.
And see, the orange line never drops there, but those are government bonds. Oh, that's great. In the short term, government bonds were the absolute hero investment. But in the long term, they only grow to 131 versus 49,000.
Yeah.
So it's time.
And you can actually even see like this was just 2021, where you can see we had that time where long-term bonds really suffered. So even here, they saw a little bit of a drop. And that's pretty significant in the short term. So
Just look at the lines, it looks like it goes together, but there's a big difference between 131 and 11,000.
Exactly. Yeah.
Why did bonds drop in that late 2021? Anybody? Inflation was real bad and the Fed was threatening, and they did raise interest rates. And then as Nash talked about duration, if I own a bond and rates go up 1 full percent, that bond could drop 10, 15, 20, 40%. And we saw that happen. And if you had a well-diversified portfolio, as he says, with short duration, we weren't experiencing losses on bonds. The stock market was down, but we know people that lost money on bonds and stocks and were quite stressed out.
So our takeaways from all of this, creating your customized portfolio, it requires allocating properly for your needs, as well as diversifying between different funds and fund companies and asset types. So to address these needs and timeframes, we'll use lateral and vertical integration concepts. And each portfolio usually will be unique to the person and the person's needs and risk tolerances. There are things like model portfolios. If you ever work with an advisor, sometimes you'll think, oh, how did they just suddenly choose all of these different things? Well, for your risk tolerance, usually they have a combination of funds that represents that risk tolerance really well. And they say, great, you're a match for this. I'm going to put you in here. They're not necessarily a bad product. I use model portfolios as a guide for my clients as well, but sometimes it's important to tweak things more towards your liking. You might just simply like value stocks more than the next person and not be so interested in tech growth and all of that stuff. So you might want more dividend focused funds. You might have stronger cash needs than the next person, but still have a decent tolerance for risk. So you could increase your cash, but also be willing to see more volatility with growth. So it's really just understanding what it is you're trying to accomplish, when you're trying to accomplish it, and how much volatility you can stomach in the meantime. And that pretty much will give you the guidelines on how to create the portfolio that's right for you. So with that, that basically brings us to our time. So before we go, any questions? Thank you. Thank you, sir. I appreciate it a lot. Okay, well, thanks you all for coming, and I hope it was helpful.